When tax rates were high, you wanted to hide your wealth. Now when tax rates are reasonable, you don't mind paying tax and keeping wealth in the normal economy.
Similarly, if you were to see 300 startups have become unicorn in the last 3 years.
I wanted to play a quick game. We call it Back It, Park It and Drop It. Hello everyone. Welcome back to our Wealth Insight podcast, where we continue our conversation with Nilesh and Saurabh. Thank you Nilesh and Saurabh for joining again. Nilesh, if I can start with you. When we move up the affluent chain, the need for personalization and customization increases, as well as the need for alternate assets. How do you think AIFs is positioned in that?
So Vinay, we are in this historic building right below Rajabai Tower. The story is that Premchand Roychand was the richest businessman of his era in Mumbai, and his mother was doing Samaik or Pratikam, a Jain practice, and she needed to hear the clock, and he built a clock tower so that his mother can identify the time. Today, we don't hear about Premchand Roychand family as much. Affluence, most importantly, needs protection. Innovation, customization, services, they are all incidental to protectionism. And clearly, alternate investment fund today can provide customization in protecting your wealth, which other financial instruments won't be able to provide. For example, most equity mutual funds will be unidirectional, long only. In AIFs, you can have long as well as short. Most mutual funds will be unidirectional in leverage, no leverage, come what may. In AIFs, you will be allowed to take leverage. Now, again, leverage and long shorts are double-edged sword. The fund manager has to use it appropriately. But used properly, they can give you protection on the downside and can increase your upside.
And Saurabh, if I can come to you, how do you see the entire private assets space? Because that's another space in which AIFs itself can give you that exposure.
So the beauty about AIFs is that through category 1 and category 2 AIFs, you can invest into private assets. Now within the key distinction between private assets and public assets is in terms of the pricing mechanism for public asset, publicly listed or publicly traded securities is more efficient than it is for private asset. Given that intrinsic nature of private asset, it lends itself more suitably for UHNI investors to take advantage of any inefficiencies that may be there in capital markets through private asset investment. The second highlight of private assets is that it allows you to take exposure to various asset classes across, let's say, real estate, credit, early stage VC, late stage PE, mid stage products. So you could do, or let's say real asset product, distressed asset product. So the variety of products that you can take or underlyings that you can take exposure to through private asset works very well for ultra HNI portfolios. And that's why we see that over the last several years, if you see the last few years, private asset invested AUM is almost 5 times from what it used to be. The number of unique investors in private assets is almost 4x up versus what it was. So clearly, this is a burgeoning and a developing asset class as far as India is concerned, and it gives access to ultra HNI and HNI investors to build, more non-correlated portfolios as well.
So Saurabh, we laid the landscape of the affluent segment. How at Standard Chartered Bank are we differentiating our proposition both for HNI and UHNI?
So there are 2 different aspects of it which I want to share with you, Vinay. One is from a client segment perspective. The way we look at affluent clients is 3 different or distinctive cohorts in that sense. One is affluent clients, HNW clients, and ultra HNW clients. As the clients go up the wealth continuum, as they get wealthier, their needs are more sophisticated, and they're looking for more advisory and more bespoke solutions from a portfolio perspective. And even from a product perspective, they need access to more complex product and advice as well. From a wealth perspective, when we look at our wealth management capabilities at Standard Chartered, there are three things that differentiate us and that is distinctive for us as a bank. One, we are open architecture, so we have no bias. Affluent clients look for unbiased advice in that sense. So we do the best in terms of product selection, whether it's asset management company or the product. We have no captive product in that sense to go and offer to our clients. The second is we are amongst the very few full stack international open architecture wealth players. So the beauty is that when a client comes to us, whether it's on the banking side, on treasury solutions, on investment solutions, Nilesh Bhai spoke about protection, leverage and structured lending for HNI and ultra HNI clients, including asset to single security and discretionary portfolios and mandates. All of that through our securities arm, the lending arm, as well as the bank. So between these three vehicles, we deliver the entire wealth proposition to our clients. Lastly, the thing that distinguishes us from from a lot of our competitors or peers is that we are truly international, both in terms of the practices on investment strategy, the kind of wealth expertise and training that we provide to our employees on the RM side and the investment specialists, as well as the access to global market that we provide to our clients for global diversification. So those are areas I would say that those are core to us, and those are areas that we are investing a lot more to be able to build capabilities for HNW and ultra HNW clients to differentiate for them.
Thank you, Saurabh. So Nilesh, if I can come to you, one question which we get often, and since you're in the asset management, how do you build a portfolio from a traditional asset perspective, and if you have to incorporate alternates in your portfolio?
So essentially, one has to understand his or her own risk profile. Many a times people come into alternate because it's fashionable, because it's trending. Well, you have to create the right equilibrium. Alternate are double-edged sword. It can give leverage return, but it can also give lower return if the call goes wrong. Alternates also have different volatility compared to normal traditional asset class. So essentially what you need is a tailor-made solution comprising of traditional assets and alternate assets to suit your risk requirement. एक मिर्जा गालिब का शेर है, उम्र भर भूल यही करता रहा, धूल चेहरे पे थी, आईना साफ करता रहा. We follow the same mistakes in our financial allocation. We choose what is in momentum rather than what is suitable to us.
Thank you, Nilesh. Very well put. If I can come to one question on international diversification. As a portfolio manager, how do you see that? Is that a very critical aspect for Indian investors?
Extremely important. Now, we can create some amount of diversification in our portfolio by investing in export-oriented companies. But that's not complete diversification. You need to create diversification at portfolio level because, one, there are so many businesses which are not present in India. For example, robotics, robotaxis, artificial intelligence. Those are futuristic businesses. You are unlikely to find them in India. The second is geographical diversification. We have 3 neighbors with which we don't share great relationship. Post-Operation Sindoor, hopefully nothing will happen, but why take a risk? And finally, there is a diversification coming from a cycle point of view. There are periods in which developed market does well. There are periods in which emerging market does well. So whether you are looking at diversification from a geographical point of view, cycle point of view, or futuristic investment point of view, which are complementary to your India portfolio, you need to invest in international assets.
Thank you, Nilesh. So Saurabh, taking that question further, how at Standard Chartered Bank are we fulfilling these international diversification needs of our clients?
So thanks, Vinay, for that question. I would again like to underline what Nilesh Bhai said from a investing perspective, that there is a very strong need for global and geographical diversification in client portfolios. We see almost a 99% home bias in a lot of portfolios. I think we are fortunate as a country where over the last couple of decades, or even more, Indian equity markets have delivered so well. But look at it, if you were, let's say, a Japan or any other country, in the last 30 years, you definitely can't have single country portfolios. And those are risks that you need to be mindful of. From a Standard Chartered perspective, international wealth access is a key enabler or a key differentiator for us. So we have 4 wealth corridors globally across markets in Singapore, Hong Kong, UAE, and Jersey, where our clients across the world can access the financial instruments across the world, across asset classes, to build globally diversified portfolios. And that's a key initiative for us. And increasingly what we see that as a diaspora, global Indians are emerging, which traditionally would mean non-resident Indians. But the way we see global Indians at Standard Chartered is actually it includes people like Nilesh Bhai, you and me, because all of us as well have international aspirations. We have children going abroad for studies, or we want to build globally diversified portfolios, or we want to buy property overseas. So in a lot of those cases, a bank like Standard Chartered can prove to be the enabler from a global access perspective.
Thank you, Saurabh. Final question. You've discussed a lot about the rising affluence and the needs. For you, from the future perspective, what is the one opportunity and one challenge? Maybe Nilesh, we'll start with you.
The opportunity and challenge both is technology. There's so much of advancement happening in such a short period of time. We are unable to figure out what will be the ramification of the same. Many people will behave like an ostrich, hoping that there's no technological change coming. But the reality is that it's coming at the speed of a train. So how do we master technology for our portfolio, for our non-portfolio related issues will be the biggest challenge.
Thank you, Saurabh, from your perspective.
So I would say the opportunities are the fact that there is significant wealth creation that will happen in India and amongst Indians. And that will lead to a lot of overload of information and products, which also leads to the challenge that clients or investors will then, in that clutter, will have to make sound investment decisions which are not necessarily hindsight based, because not always either the asset class or the return that the asset class has given in the last few years is a predictor of future returns. So how do you deliver good quality of advice to clients, and how do investors build good portfolios is, I think, going to be a challenge. Even the client expectation or the investor expectation, I think something will require moderation as we go ahead. So those are areas where I see challenges. One other opportunity, if I may, is I think India is sitting at the cusp where, with the development of GIFT City, I think whether it's resident Indians wanting access globally, non-resident Indians wanting access to India, as well as even a new breed of individual investors, which is foreign nationals, wanting to access India as a market. So I think for wealth managers and asset managers, wealth managers like us and asset managers like Nilesh Bhai, I would say that's the next decade in terms of opportunity. I would say that is again a very interesting opportunity.
Thank you so much, Nilesh. Thank you, Saurabh, for joining this podcast. And thank you, viewers, for tuning in. For more such insights, stay tuned for our next episode of the Wealth Insight podcast. Thank you.